So this is Chapter 3, Part 4. We're just going to quickly finish up on the chapter with respect to adjustments. And in this phase, probably the most important section of all is to understand and be able to analyze what is the financial statement impact of making adjustments. And specifically, what accounts or what categories are affected by making adjustments. So let's see what happens if we were to not make the adjustments. So in this particular example, we're going to look to see if we were to not make the adjustment for unearned revenue, which becomes earned. So here in this case, we're going to omit or not make the adjustment for $10,000 of unearned revenue, which becomes earned during the period. Maybe we've taken the afternoon off and we forgot to make that adjustment at the end of the period. So the question is, what financial statement categories are overstated and which are understated as a result of not making that adjustment? So the first thing we're going to do is we're going to go ahead and just take a look at that adjustment. What would that adjustment have been if we made the adjustment? So let's look at the adjusting entry. And the adjusting entry, if you remember, what we're going to do is we're going to, if unearned revenue becomes earned, we're going to transfer that portion from unearned to earned. So we're going to reduce the liability. Reduction of a liability is a debit. So we're going to debit unearned revenue. By $10,000. And of course, revenue is always a credit. So revenue is increasing. And so revenue always being a credit, credit revenue. Revenue is going up. So that's what our adjustment would have been, but we forgot to make the adjustment. So what's the effect of forgetting to make that adjustment or omitting that adjustment? Well, first of all, I think it's pretty clear. Revenue would be understated. In other words, revenue would be too low if we were to do that. And I'm just going to use O and U as overstated or understated. So revenue would be understated. Expenses, there should be no effect on expenses. None of these, either one of those entries have no expense impact. So if we have no expense impact and revenues are understated, then of course net income would be understated. Assets, none of these accounts involve an asset account, so assets are not affected. Liabilities. In this case, what we're doing is the entry would reduce liabilities. If we do not make that entry, then liabilities would be too high. Unearned revenue would be $10,000 too high, so it would be overstated. And so equity, we can look at it two ways. We can first look at the fact that net income is a component of equity, and if net income is understated, then equity should be understated. The other way of looking at it is the accounting equation. Assets equals liabilities plus owner's equity. If assets remain unchanged and liabilities are too high, then to even out the equation, equity, of course, would then be too low. So that's the financial statement impact of not making that adjustment. So if one were to look at the financial statements, net income would be too high. Of course, revenues would be too high. Net income would be too high. And even the balance sheet is affected. Liabilities would look too high and equity would look too low. So let's take a look at another quick example. So here in this example, another example, in this case we failed to record depreciation expense for the period of $5,000. So let's take a look at that. We'll call this example 1 and this example 2. So over here, this is 1, and we'll take a look at what's the effect of example 2. So here, again, first thing, let's take a look. What would that adjusting entry have been had we made it? And if we remember back, our adjusting entry to record depreciation is to debit depreciation expense. And again, I'm just abbreviating these labels because in the interest of time and to save my wrist from writing too much. So we debit depreciation expense. Of course, expenses are always debits. And we're going to credit, remember, instead of crediting the asset, we're going to credit the contra asset account, in this case what's called accumulated depreciation. And remember, that's really a contra asset account, so it attaches itself to the asset. It's shown on the balance sheet as an asset. Okay, so that's our entry that would have been recorded. However, we failed to record that. So what's the effect on the financial statements? Well, if we forget to record that. Well, first of all, revenues, there is no effect on revenues because neither of those accounts are impacting a revenue account, so no effect there. Expense, if we fail to record the expense would be too high. So we'd have expenses which are overstated. If expenses are too high and revenue is the same, then of course net income would be too low. So we have expenses which are too high. That would mean net income would be understated. I'm sorry, let's go back. That's my mistake. If we forgot to record the depreciation expense, then we would not have expenses at the level they should be. Expenses would be understated. So if we forget to record the expenses, our expenses would be too low. Expenses would be understated. And if expenses are understated, net income is overstated. So again, sorry about that, but so if we're forgetting to record expenses, it's going to make us look like our net income is higher because we have less expenses. In this case, we want to make sure that we record depreciation expense, all these adjusting entries with respect to expenses. Otherwise, it's going to make it look like our net income is too high. So in this case, if we forgot to record depreciation expense, our expenses would be understated or reflected too low. And of course, our net income would be too high. Assets. So what's the effect here? Right now, this would be a credit to an asset account. If we forgot to do that, then our assets would be too high. So our assets would reflect less of depreciation. They would be reflected at a higher amount. So we would not have that credit against our asset accounts. And so therefore, our assets would be overstated. None of these accounts impact liabilities. And so, again, two ways of looking at it. Because our net income is overstated, our equity would be overstated. Also, the accounting equation, if assets are overstated, assets equals liabilities plus equity. And so if assets are overstated and liabilities are the same, then equity would also have to be overstated. And by the way, each one of these would be $5,000. Okay, so this is the way that we'd want to be able to understand what the effect is on our financial statements. If you're given a problem like this, the way to solve it, I think first would be to look to see what the entry would have been that you would have made, and then be able to understand, okay, if I did not make that entry, what is the effect on each one of these categories? Would they be too high or too low relative to where they should be? So that's the last part of the chapter, but probably one of the most important, because remember, in financial accounting, we're always trying to understand what is the effect of all of these accounting entries or transactions ultimately on the financial statements, because we're using the financial statements for decision making. And in this particular case, by omitting these entries, it's going to lead us to making erroneous or false or incorrect decision making or decisions, because we're looking at incorrect financial information.